Aggregate demand, part 2. The components of aggregate demand. As mentioned in the previous video, aggregate demand changes when one of the components of aggregate demand changes. Remembering that aggregate demand is equal to consumption plus government spending plus investment plus net exports, one of these components must change in order for aggregate demand to change. And in any essay that we write about aggregate demand, we'll have to justify talking about a shift in aggregate demand by explaining which of these factors has changed. So first we'll deal with consumption. These are the main factors that would cause consumption to change. The most important here is probably income. As we learned in microeconomics, people's level of spending depends very much upon their income. As they earn more, they tend to spend more money. Wealth has a similar impact. As people get wealthier, then they're more likely to take risks with spending because they have more assets to back them up. And again, if their wealth is decreased, then they will also tend to spend less. The other key one here is interest rates, and this is related to the cost of borrowing. If interest rates are lowered, for example, then the cost of borrowing decreases. If the cost of borrowing decreases, then people are more likely to do that to increase their spending. At the same time, of course, as interest rates come down, saving becomes less attractive as there is a lower rate of interest to earn on those savings. And it's worth considering also that existing repayments on debt may also be lowered by a lowering of the interest rate, freeing up more disposable income for consumers to spend. Consumer confidence or expectations is essentially how people look at the future and what they think will happen. If people are confident about the future, they'll be happy to spend the money they earn now. But if they look pessimistically at the future, they may be more wanting to save their money to guard against any disasters that might occur in the future. What is their perspective of the economy? If all is well, they will spend money. If they think things will go badly, then they will not. The last factor here, the level of indebtedness, is really perhaps a limiting factor on the other ones here. If people are already in high levels of debt, then an increase in income or a lowering of the interest rate may not result in any extra spending because people have got a lot of debt and they don't want to incur any more, and they're more interested in paying that off than they are in increasing their current levels of spending. Looking at investment then, it's worth differentiating at first between two different types of investment. Firstly is what we call replacement investment. This is where firms are simply replacing capital that has worn out or that is too old or needs updating or is broken down. This doesn't change the productive capacity of the economy. Alternatively, there is induced investment, which is in order to increase the productive capacity of the business and therefore the economy. Normally there's been an increase in demand and firms will want to increase their capacity in order to meet that demand. So the factors in investment primarily will be concerned with interest rates here, which is common to consumption as well. Again, the cost of borrowing is the reason that this affects the level of investment. If it is cheaper to borrow money, there will be more potential investments with a rate of return that is higher than that interest rate, and there will be more things that firms will find to do that will be profitable with borrowing that money. Of course, we also have the effect on saving, as firms would keep their profits in savings rather than invest, and if there's a smaller return from that, then again, more investments become attractive. Growth is another main determinant. Businesses invest in order to keep up with a growing economy, growing demand for their goods and services, and so therefore we expect more investment in times of growth than we do in times of recession, unless potentially you're a producer of an inferior good, in which case that relationship might be reversed. Business confidence and expectations work very similar to those for consumers. The more positively businesses look at the future, the more likely they are to invest. Future growth will lead to investment now. If they think growth will be negative or very small in the future, there is no reason to invest at the current time. Technology is also one here. If new technology comes out, businesses may feel that they need to invest in that technology to keep up with competition. So the rate at which technology becomes available might affect the rate at which investment occurs. But again here, the level of indebtedness of the firm may prevent investment from occurring because they have high existing levels of debt, and so therefore there may not be any price at which they're willing to borrow more money because they're struggling to make repayments, and they may be more concerned with paying off existing debt even when there is increased revenue streams. Government spending changes for all sorts of reasons, impossible to list even any reasonable number of them here. Often, though, it's worth remembering these changes might be deliberate changes to influence aggregate demand. If there is a recession, then as we'll look under fiscal policy, governments may increase their spending simply to try and increase what's going on in the economy. So there could be government policy changes or just changes in economic conditions that cause government spending to change. One other point of terminology worth mentioning here is the difference between discretionary and automatic changes. So discretionary simply means that there has been a deliberate change in spending, that this was done intentionally. Some changes in government activity and spending happen automatically. So something in the economy changes and this triggers an automatic response from some part of the government's budget. This will largely be talked about in terms of automatic stabilizers, a future topic to do with transfer payments, and we'll get onto that at a later time. So changes in net exports, exports minus imports. One of the main determinants here will be the levels of income in different countries. If income rises in our country and people have more disposable income, then they will spend more money. Some of the spending will be done on imported goods, and therefore imports in the economy will increase. The reverse is true when we look at other countries. If their income goes up, then they will also consume more goods, and some of the goods they consume will be imports, and some of those may be our exports. So typically we'd say an increase in income domestically will mean more imports, an increase in incomes overseas and our trading partners will result in more exports for us. Clearly, exchange rates here are also very important because they affect the prices of goods and services from different countries. And as the exchange rate changes, the price of goods changes in another country, and therefore the spending will go up and down. As a rule, we can say if our country depreciates, that means goes down in value, that means that our currency becomes cheaper for other people to buy, and as a consequence our goods become cheaper for people to buy, and therefore we would expect to sell more exports. And the inverse being true for imports, as it's more expensive to buy another country's currency, it's more expensive to buy their goods, and we will import less. In terms of an appreciation, we can reverse all of the above. Inflation is also important. If we have high inflation, our prices are going up relatively quickly compared to other countries, and so our goods are becoming more expensive over time and people are less likely to buy them. The final one here, trade barriers, encompasses all sorts of things we'll talk about in international economics next year, but anytime there is a restriction on trade between countries, then obviously that will reduce exports and imports, depending on the nature of that trade barrier. So a reminder again then, an increase in aggregate demand, as seen on the left, will occur when there is an increase in consumption, government spending, investment or net exports, according to one of the many factors we've talked about in this video. On the right is a decrease in aggregate demand, and this will happen because of a decrease in consumption, government spending, investment or net exports, again according to the factors that we have discussed.